Before we begin, this video is for educational purposes only. Nothing here is financial advice. Always do your own research before making any investment decisions. Now, here is a question worth sitting with. Do you actually know what is inside your emerging market ETF? Because one of the countries in that basket, Indonesia, almost got kicked out of one of the world's most important index benchmarks. And if it eventually is, the ripple could reach your portfolio directly. On 24 June 2026, MSCI announced its semi-annual index review. The headline, Indonesia stays in the emerging markets index, for now. But buried in the announcement was a warning. Indonesia has been placed on a watch list for the November review. That watch list is not a gold star, it is a yellow card. MSCI stands for Morgan Stanley Capital International, and it runs some of the most widely tracked financial benchmarks in the world. When MSCI classifies a country as emerging markets, trillions of dollars of passive funds and active managers benchmark against that classification. It is essentially a gatekeeper deciding which countries get access to global institutional capital. MSCI divides the world into three broad tiers: developed markets, emerging markets, and frontier markets. Think of it as a league system. Developed markets is the top flight. Think the United States, Germany, Japan. Emerging markets is the second tier. Think China, India, Brazil, Indonesia. Frontier markets is the third division. Smaller, less liquid, with far fewer foreign investors tracking them. If MSCI downgrades a country from emerging to frontier, funds that track the emerging markets index are forced to sell that country's stocks. They cannot hold frontier tier assets in an EM mandate. This is not a gradual drift, it is a mandated, often rapid, liquidation by a large chunk of the investor base. Estimates suggest that a downgrade of Indonesia from emerging to frontier status could trigger roughly $13 billion of outflows from Indonesian equities. To put that in perspective, that is billions of dollars of sell pressure concentrated in a single market that is not as deep or liquid as, say, the United States. Price impact in a smaller market can be severe. MSCI does not upgrade or downgrade countries on a whim. They evaluate market accessibility, things like how easily foreign investors can move money in and out, whether there are currency restrictions, how efficient settlement systems are, and whether regulations treat foreign capital fairly. Indonesia has faced concerns on several of these dimensions over recent years, which is what put it in the spotlight. The next decision point is MSCI's November 2026 semi-annual review. Between now and then, Indonesia's government and regulators have a window to demonstrate improvements. Whether or not they make meaningful progress in that window will determine whether this watch status quietly disappears or escalates into an actual downgrade. Here is the part that connects directly to you as a European investor. If you own a broad emerging market ETF, whether it tracks the MSCI Emerging Markets Index or a similar benchmark, you almost certainly hold Indonesian equities as part of that basket. You may not have picked Indonesia, you may not even know you own it, but you do. A broad emerging market ETF does not pick winners. It buys a slice of every country in the index, weighted roughly by the size of each country's stock market. That means a handful of large economies dominate the fund, while smaller countries like Indonesia sit at a much lower weight, but they are still there, and their risks travel with you. When you look at a typical broad EM ETF, the concentration at the top is striking. China, India, and Taiwan together represent a very large share of the index. Easily more than half of the total weight in most benchmarks. That means the fund's performance is driven more by what happens in those three economies than anywhere else in the basket. Country-specific risk is exactly what the Indonesia story illustrates. It is not just about whether a company is profitable. It is about whether the government, where that company operates, creates an environment where foreign investors can actually access their money, convert their returns, and exit when they want to. Political decisions, regulatory changes, and currency policies can all affect this. Now let us be balanced, because emerging markets are not just a list of risks. The case for EM exposure has always rested on growth. These economies often have younger populations, rising middle classes, expanding consumption, and faster growing gross domestic product than developed markets. Over long time horizons, that growth can translate into equity returns that outpace slower growing developed economies. But the risks are equally real. Emerging markets have historically been more volatile than developed ones. Currency swings can erode returns even when local stock markets perform well. Corporate governance standards vary widely, and as the Indonesia story shows, index inclusion itself is not guaranteed. The rules of the game can change. Any honest conversation about EM ETFs has to acknowledge the China question. China is by far the largest single country weight in most EM indexes. That means your EM ETF is, to a significant degree, a bet on China's economic trajectory, its regulatory environment, and its geopolitical relationships. Some investors are comfortable with that, others are not, and have chosen to exclude China specifically. For European investors who want emerging market growth without the full China concentration, there are now ex-China emerging market ETFs available on major European exchanges under UCITS structures. These funds track EM indexes that simply exclude China, giving you India, Brazil, Taiwan, South Korea, and others without the largest single country weight. Whether that trade-off suits you depends on your own view. On the other side of the spectrum, some investors deliberately seek frontier market exposure for diversification and early-stage growth potential. Frontier markets are less correlated to global equity cycles, at least in theory, but they come with even lower liquidity, even higher country risk, and often thinner regulatory protections. If Indonesia were downgraded, it would join that tier. There is no universal answer to how much emerging market exposure is right for any individual investor. It depends on your time horizon, your risk tolerance, your existing portfolio composition, and whether you already have indirect EM exposure through European companies that earn revenue in emerging economies. A common starting point in portfolio construction is to let your own conviction and comfort guide the allocation. If you currently hold an EM ETF, there is a simple first step. Look up the fund's fact sheet or the index it tracks and check country weights. Your ETF provider publishes this regularly. iShares, Vanguard, Amundi, and others all provide detailed breakdowns online. That will show you exactly how much of your money is in each country, including Indonesia. Between now and November 2026, there are concrete things to monitor. Watch for any announcements from Indonesia's financial regulators or central bank on foreign investor access. Watch for MSCI's own commentary on the watch status, and watch for how Indonesian equity markets themselves react to any news. Market prices often price in risk before index decisions are formally announced. The Indonesia story is a reminder that passive investing is not the same as risk-free investing. When you buy an index ETF, you are not avoiding country decisions. You are outsourcing them to the index committee. That is often a perfectly reasonable choice. But it means you should understand what the index is choosing on your behalf, and what the rules are that could change the composition. A note for any viewers watching from Indonesia or Southeast Asia: the decisions MSCI makes about index classification have real consequences for local markets and local investors as well. When foreign institutional money flows in because of index inclusion, local valuations often rise. When it flows out because of a downgrade, the impact is felt on the ground. It is a reminder that global index decisions and local economic realities are deeply connected. For European retail investors specifically, remember that EM ETFs come in different structures. UCITS-compliant funds domiciled in Ireland or Luxembourg are generally the most tax-efficient and investor-protective options available on European exchanges. Non-UCITS funds or US-domiciled ETFs may not be suitable or even legally available to retail investors in the European Union due to PRIIPs and MiFID regulations. Let us bring it together. Indonesia is on MSCI's watch list after being kept in the Emerging Markets Index in June 2026. A downgrade in November could trigger an estimated $13 billion of outflows. If you hold a broad EM ETF, Indonesia is already in your portfolio. The lesson is not to panic. It is to know what you own, understand concentration risk, and decide consciously how much emerging market exposure fits your strategy. If this episode helped you think more clearly about what is inside your emerging market ETF, like, subscribe, and leave a comment below. We read every one. You will find a link to our free newsletter in the description, where we cover stories like this with a bit more depth every week. And as always, remember, this channel is education, not financial advice. Do your own research, speak to a qualified advisor if you need one, and invest in a way that lets you sleep at night. I am the European Investor. See you in the next one.